Alphabet stock has gone from $26 to over $160 over the last 10 years. That's a 6x return. And it's up almost 50% in the last year. It's one of the largest companies in the world with a market cap approaching $2 trillion. And it's making a massive push into AI with Google DeepMind and leveraging its rapidly growing cloud business and AI capabilities. So, is now the time to buy this tech juggernaut? Tune in and find out. 3 points that we will be covering in this video. Number one, the business model. There's 4 components: advertising, subscriptions, platforms, and devices, Google Cloud, and other bets. Google, or Alphabet, has been self-described as an AI-first company since 2016. Part 2. 2023 and the future. CEO Sundar Pichai in the 2023 wrap-up spoke about 4 main topics, and I have analyzed and highlighted the most important points just for you. Lastly, number 3, valuation. Wall Street has Google, or Alphabet, at an average of $170 per share. That's a 7% discount, with a high of $190, 22% discount, a low of $141, which is 10% overvalued. On Wall Street, we build a 3-statement financial model culminating in a discounted cash flow, or DCF, valuation. I have built a 3-statement model and think that Alphabet is a solid hold at current levels, and I can't wait to give you all the details. So let's dive right in. Part 1, the business model. So 4 components to Alphabet's business model. Number 1, advertising. Today, it's 77% of revenues. 5 years ago, it was 85% of revenues. The 5-year growth is 2x. In 2023, that was $238 billion of revenues. This is Google Search, YouTube Ads, Google AdSense, and Ad Manager. Number 2, subscriptions, platforms, and devices. That's 11% of revenues today. It was 10% 5 years ago. It's had 2.5x growth over the last 5 years. It's $35 billion of revenues. This consists of subscriptions like YouTube TV, YouTube Music and Premium, NFL Sunday Ticket, platforms like Google Play, devices like Nest, Fitbit, and the Pixel family. Number 3, Google Cloud. That is 11% of revenues today. It was 4% 5 years ago. It has a 5-year growth of 5.7x. It's $33 billion of revenues. This consists of cybersecurity, databases, analytics, and AI offerings like Vertex AI and Duet AI for Google Cloud. Also, Google Workspace falls under here. We're talking about Calendar, Gmail, Docs, Drive, and Meet. And lastly, other bets. This is only 0.5% of revenues. It was 0.4% 5 years ago, as a 5-year growth of 2.6x. It's only $1.5 billion of 2023 revenues, but it's very interesting. It's an incubator of startups and venture capital investments. Think of like Google's version of Shark Tank. Right now, most of them are focused on healthcare-related services and internet services. So what's the takeaway? This is a self-described AI-first company. Since 2016, it has a huge and innovative and growing focus on AI and the cloud. Okay, part number 2, the future. So 4 topics that Sundar Pichai focused on in the 2023 wrap-up. Number 1, AI and search. So Gemini was birthed out of Google DeepMind, an AI research lab that was started in 2010 with investors like Peter Thiel and Elon Musk. It was bought out in 2014 for $0.5 billion. Now, Gemini is engineered to understand and combine text, images, audio, video, and code. It applies generative AI to search and enables more complex questions. Advertisers are using Gemini to come up with search campaigns. Also, there's Bard. This is a conversational AI tool that's more capable at things like understanding, summarizing, reasoning, coding, and planning. It's available in 40 languages and 230 countries. Topic number 2, subscription. So YouTube is the key driver of subscription revenues. YouTube Music and Premium are available in 100 countries. YouTube TV has a ton of momentum with NFL Sunday Ticket, and customers say they love the navigation, multi-view, and unlimited DVR. Number 3, Google Cloud. So 2 pieces here: Vertex AI, which is for developers building generative AI applications to discover, customize, augment, and deploy over 130 generative AI models. The API request from developers is up 6x from the first half to the second half of 2023. Also, there's Duet AI, which has 2 components: Google Workspace to improve productivity and creativity, and in the Google Cloud platform to assist software developers and cybersecurity analysts to write software better, faster, with AI code completion, code generation, and chat support. And then topic number 4, investments and the future. So the company is very much focused on investing in data centers to support new wave AI-powered services. So a few examples of things that they're investing in and focused on. Pixel 8 is the company's first AI phone. It was awarded Phone of the Year by numerous outlets. Waymo has reached over 1 million fully autonomous ride-hailing trips. And lastly, Isomorphic Labs. They've entered into strategic partnerships with Eli Lilly and Novartis to apply AI to treat diseases. So what's the takeaway? The company's leveraging AI for search. They're beefing up subscription revenue with YouTube. Google Cloud is leveraging AI and having massive success with developers. They're also investing in data centers to prepare for the AI wave while continuing to invest in promising tech startups. If you're enjoying this, please smash that like button. All right, part number 3 of our video, the valuation. We're starting with the balance sheet. So a few key points here. Company has tons of cash, almost $111 billion of cash, and they've had over $100 billion of cash and cash equivalents for the last 7 years. Now, while debt has increased 3 times in the last 5 years, they have very low leverage, less than 1% of their total capital, and they've been net cash, meaning cash has been greater than debt. It's been an average of $109 billion net cash for the last 7 years. Lastly, there's been a 57% increase in retained earnings over the last 5 years. They're investing heavily in AI and the cloud, which we're going to see next in the income statement. So what's the takeaway? They're very conservatively financed. Their net cash by over $100 billion. They have a solid balance sheet and a AA+ credit rating. Let's hop in the model. Okay, some interesting things here with the balance sheet. What we see is massive amounts of cash and cash equivalents, almost $111 billion. Also, they've been net cash, averaging over $100 billion of cash greater than debt for the last 7 years. Truly remarkable stuff here. Now, you look at the debt and you say, wait a sec, Ken, this has increased pretty substantially, but on a relative basis, it's not that large and it's very manageable for the company. Another really interesting thing, retained earnings has had a really big increase while the company is still able to do share repurchases and reinvest in the company. This is really great stuff that we love to see. Okay, the next statement is the income statement. So revenue has grown 2.2x in the last 5 years. Net income has grown 2.4x. What is this symbolic of? Phenomenal cost control and positive operating leverage. Remember, this is a company that has over $300 billion in revenues. Also, huge investments in AI and the cloud via R&D. They've had $155 billion of research and development over the last 5 years and $42 billion last year. They're reinvesting in the business, returning capital to shareholders, which we're going to see next in the cash flow statement. Also, operating margin is up 4%. Net margin has more than doubled over the course of the last 7 years. This is symbolic of tremendous cost control. Remember, revenue is what you make, net income is what you keep. Also, the company is net interest positive, which means interest income is greater than interest expense by about $3.5 billion. So what's the takeaway? The company is growing responsibly with revenue growth outpacing costs, indicative of positive operating leverage. They have a 5-year average return on invested capital of 20% and a 5-year average return on equity of 23%. These are eye-popping returns for a company of this size. Let's dive into the model. Okay, so as we mentioned here, tremendous positive operating leverage. 5-year growth in revenues, 2.2x. 5-year growth in net income, 2.4x. Their R&D has been massive. They have $155 billion over the last 5 years, $42 billion just last year. They have net interest income, meaning their interest income outpaces their interest expense by the tune of $3.5 billion. This company is growing rapidly, and I'm really excited for the future. Next, we have the cash flow statement. This is the most important of the 3 financial statements. So a few key points here. Free cash flow has tripled in the last 5 years, while operating cash flow has more than doubled. Like other tech companies, even though they have no dividend, they have been returning capital to shareholders. They've done $221 billion of share repurchases, and they're reinvesting in the business. Over the last 5 years, they've had over $13 billion in acquisitions, over $134 billion of CapEx, so about $150 billion going back into the business. Also, they're making tons of money off of their cash, with $544 billion of positive cash flow over the last 5 years. And the cool thing, they're using this to buy back shares, not net income. So what's the takeaway? Cash is going to 17x by 2028 if the 5-year average trend continues, and they're projected to invest over $214 billion in CapEx over the next 5 years. Let's hop into the model. Massive growth in free cash flow. This is something that we love to see. Similarly, they have a really tremendous growth in their operating cash flow. A few other important things. Remember what I said about their cash being invested. So they've received $544 billion on the cash that they've invested over the last 5 years. They've used this for acquisitions as well as share repurchases, returning capital to shareholders. The crazy part, in spite of all of that, they're scheduled to 17x their cash by the end of this model. So this company is just a cash machine. If you're finding this helpful, please hit that like button. All right, next we have forecast drivers and DCF assumptions. So they have incredible cost control despite high revenue growth. They've shaved 2% over their bucket of costs. That's about $6 billion of savings. Also, R&D, research and development, is above its tech peers, approximately 14% of revenues. That means they're investing in innovation. Also, $90 billion of debt has been repaid over the last 5 years, with another $6 billion coming over the next 5 years. This is very manageable. They have a very moderate beta for a tech firm, only 1.1, which leads to a very moderate WACC of 9.1. So they have low leverage, less than 1%, and a AA+ credit rating. So what's the takeaway? Conservative assumptions equal conservative results. Let's hop into the model. All right, so some of the things that we mentioned here: tremendous revenue growth. For a company with $300 billion of revenues, to have double-digit revenue growth on average over the last 5 years is unbelievable. They've been able to maintain their research and development allocation, which is huge. That money's going into AI. That money's going into the cloud. Also, very responsible from a capital structure perspective. They've paid down almost $90 billion of debt, and they only have $6 billion coming up in the next few years, which is super manageable. All right, next we have the DCF valuation. So we ran 3 scenarios: a bear, base, and bull case. With the current model at base, we're going to take future cash flows, discount them back to today to get to TEV, or total enterprise value. This company is high growth with lots of cash, big investments, and a push into AI. But is it worth buying today? Remember, the stock is up almost 50% over the last year. Wall Street has Google, or Alphabet, at an average of $170 per share. That's a 7% discount, with a high of 190, 22% discount, a low of 141, which is 10% overvalued. Let's hop in the model. All right, so as we see, we have a bear, base, and bull case scenario. That'll be important later on for the scenario analysis. We're running the current one at base. 4.62% risk-free rate, 5-year risk-free rate, 1.1 beta, equity market risk premium 4.13. That gives us a cost of equity of 9.17%. AA+ credit rating, very high. So that gives us a pre-tax cost of debt of 5.32, effective tax rate 21%, post-tax cost of debt of 4.2. Very low leverage, less than 1%. We get a weighted average cost of capital, or discount rate, of 9.13%. Now, a few other things to note here. They have over $110 billion of cash and cash equivalents. Now, the last thing that's very important here: the terminal EBITDA multiple. Remember, this is the value of the model from the end all the way out into infinity. So I chose 18 times despite the fact that the comps are 21 times. And the reason being is, over the last 15 quarters, the range for Alphabet has been 12 to 23 times, the midpoint 17.5. So 18 is actually a very reasonable terminal multiple for us to go with. All right, in the moment we've all been waiting for, the DCF valuation, we have EBITDA less DNA. That gives us EBIT. We subtract out the cash taxes to get EBIT or NOPAT. We add back DNA. We also take into account operating working capital, strip out the CapEx. That gives us free cash flow to the firm. We have our terminal value, which, remember, is 18 times the terminal EBITDA. We take all of those cash flows to discount. We multiply it by the discount factor, which is 1 divided by 1 plus WACC to the T. We then multiply all of those out to get the present value of the cash flows. That leads to total enterprise value. Going down from there to get to equity value, we subtract debt, we add cash, we subtract non-controlling interest, we add associate investments, we divide it by the shares outstanding. That gives us an implied share price of $174 per share. The current share price, $158.26. That's a 10% discount, which is a solid hold. Remember, on Wall Street, greater than 20% discount is a buy, between 0 and 20% is a hold, and then anything above 0% is a premium. We're not going to pay more for something than we think it's worth. All right, next we have the sensitivity and scenario analysis. So we ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and weighted average cost of capital versus the terminal multiple. Now, from that analysis, we got 2 of the 50 models, 4% said sell, 44 out of 50, or 88%, said hold, and 4 out of 50, or 8%, said buy. Now, we also ran each of the 3 scenarios equally weighted, 33.3% each. We got a weighted average value of $175, which is about 11% discount. Now, what's the takeaway? Utilizing conservative assumptions, we show a solid hold rating for the stock. So it's at a discount, but it's not what we would consider cheap. Let's hop in the model. Okay, so as I mentioned, you see a lot of yellow here. Yellow corresponds to hold. So ultimately, we have the vast majority, 88% are hold. We have a few more buy than sell, which is definite positive. And then we come down to our scenario analysis. So in the scenario analysis, we equal weight the three possibilities. So bear, which is downside, base, which is the current case, and bull, which is an upside. We get a sell in the bear case, a hold in the base case, and a buy in the bull case. So we get about a weighted average of $175 a share. That's almost an 11% discount to where it's currently trading. That is a solid hold rating. All right, so here's the wrap up. Wall Street has Alphabet at an average of 170 per share, which is a 7% discount, a high of 190, which is a 22% discount, and a low of 141, which is a 10% premium. Our analysis showed Alphabet at a value of around 175 per share, which is 11% discount. Now, you should always seek the advice of an investment professional always, but I do have a position in Google. I got it in early 2023 at about $87, but if it got below 150, I would buy more. The valuation is at a slight discount. It's not a bad spot to start a position, but it's definitely something where we would be on the lookout for pullbacks. With almost $111 billion in cash, very little debt, a AA+ credit rating, and hundreds of billions of capex allocated, Alphabet is a tech leader in AI with a bright future, and I'm excited to see what they do. If you like this and want to see another tech valuation, check out my Amazon model here or my Microsoft model here. And if you found this valuable, please share this with someone who you think would enjoy this. Be relentless.